Hi, folks. This is Colin Richards, president and founder of Lord and Richards, and I'm thrilled to be talking to you today here on the Lord and Richards Show. You know, we're talking to people every day just like you who are worried that circumstances beyond your control are going to harm your retirement. So what we do is we help you build a financial independence roadmap, a plan, so you can enjoy retirement without worry from a biblical point of view. And of course, we want you to do this so that you can take those amazing things that God has provided and bountifully given you and do wonderful things for Him. So let's talk today about an important subject that I'm seeing a lot in the media and I'm seeing a lot of articles about, and I think we can flesh out the picture a little better here than what you're reading and seeing online. And the question is the 60-40 portfolio dead? Now, some of you, my listeners, are saying, well, first of all, what is a 60-40 portfolio? Well, for a long time, investors have been generically put into or tended toward the 60-40 portfolio. And regardless of their age, their goals, how long it is till they retire, most people's portfolios trend toward this mixture. And it is 60% stocks and 40% bonds. The 60-40 portfolio, 60% at risk, 40% bonds. Stocks provide the exposure to growth that we all need, right? But they come with risk. And bonds provide the exposure to income and maybe a relatively lower degree of risk. But the problem is that this really doesn't take into account anybody's individual situation. It also ignores an important rule. The rule is called the Rule of 100, and it's being thrown out. But a long time ago, advisors began to realize that as folks get older and get closer to retirement, it's more and more important that you take risk off the table. And so the Rule of 100 simply says, well, take your age, if you're 50 years old or 60 years old, put a percent symbol after it, and that's about how much you need to have in safe assets. Well, you can see a 60-40 portfolio might work great for a 40-year-old person if they're using a safe bond portfolio with 60% at risk, but not so great for a 70-year-old person, okay? It's considered moderate. And one of the reasons so many people end up in this 60-40 stocks to bonds allocation is that when advisors are assessing their clients' risk, everybody kind of views themselves as moderate. And so the tools we use at Lord & Richards are really designed to help you dial that in much more specifically. It's also considered somewhat diversified because stocks and bonds in the prevailing wisdom don't usually go down together. Okay, that's the prevailing wisdom. Between 1926 and 2021, the annualized return was around 8.8%. So that's what you'll hear out there. But folks, that's a lot of time. None of us is going to have a retirement that long. And the reality is that your 20 or maybe even 30-year retirement might fit into a period where your returns would be much, much lower and your experience much, much more volatile. In 2022, this year, investors have once again been reminded of the problems of the 60-40 portfolio. It is, in fact, possible for both stocks and bonds to go down at the same time in the same year. We saw this in the 2007, 8, and 9 crash, when 14 out of 16 asset classes were all down at the same time. And folks, we need to learn lessons from history. As someone has wisely said, is what we learn from history is we don't learn from history. So let's learn on this one. We saw this happen again this year because the government spending policy, let's just call it like it is, free money, resulted in runaway inflation. The price of everything went up. And that resulted in the need for the government to act by cooling the economy, and that means raising the cost of borrowing, right? We're seeing it everywhere, raising rates. Well, a lot of those safe bonds that people use in their bond portfolio are longer term. It's considered very safe, very secure, long-term bonds versus short-term. But those are especially at risk when rates rise because the bonds we hold in our portfolio now become worth less than the new bonds that are issued with the higher rates. So we saw long-term bond portfolios this year drop as much as 25%, showing that bonds can drop just as badly as stocks can. And with impeccable timing, economic headwinds, the war in Ukraine, bad government policy combined to deliver a punch to stocks, which had similar downside returns. And we don't yet know where the bottom will be for both of those asset classes. So the government's long-term policy of keeping rates low, not in 2022, but in the past, has also hit bond owners by negatively impacting their returns. So not only can they suddenly dramatically see losses when rates rise, but keeping rates low over a long period of time, which has been the policy since the crash in 08-09, has really hurt savers, so that the yield on those bonds has been very low. It's been a catch-22. You say, well, then I'll just get rid of all the bonds and put all my money in stocks at risk. Well, some advisors have been pushing people that way, gradually switching their clients to a higher percentage in at-risk assets, feeling like low rates in the recent past were unfairly keeping your growth low. And that's true. Of course, this has resulted in the portfolios that we're seeing when people come in for the first time having extraordinarily high amounts of risk relative to the goals that the people we're talking to have. So, pre-retirees, retirees, you are especially vulnerable, and you run the risk of delaying retirement. I saw this with my own eyes in 08-09 as people either delay their retirement, hoping to wait till the stock market recovered, which took all the way to 2013, or just going back to work, conversation after conversation with people who did not have the right kind of plan in place, returning to work and ending their retirement. Folks, if you're anywhere near retirement within 10 years or currently in retirement, you have got to develop a portfolio that includes safety. But we need to really look hard and find alternatives to bonds, because the risks of bonds, as well as the historically low rates, are making them less and less attractive. There is a better route to those who still want growth, but aren't interested in shifting your portfolio to a high-risk portfolio. It's really about finding those bond and income alternatives. And I want you to continue on to our very next segment, where we're going to discuss, are there alternatives to bonds for safety and income? In the meantime, you might be saying, well, Colin, it's clear that I need a plan. I need a plan in place so that I don't run out of money before I run out of life, and so that I don't pack my portfolio with the wrong kinds of tools. Well, that's where we come in. We would love to conduct a complimentary financial independence review and determine if you're ready to retire or if you're in good shape as you continue forward in retirement. It just starts with a simple phone call.